You've probably heard it a million times. Your systematic investment plan, your SIP, is the safest, surest way to build wealth. But what if that's not the whole story? Today, we're going to ask a really important question. Is your SIP really as safe as you think? Let's find out.
From the moment you even think about investing, what's the one piece of advice you hear over and over? Be disciplined. Just keep that SIP going. Don't worry about the market going up or down. Just stay the course. And look, there's truth to that. It's a great way to build a habit.
And this creates this really comforting idea, right? That your SIP is this kind of financial autopilot, a set-it-and-forget-it machine that just churns out wealth for you. It feels like as long as you keep feeding it money, nothing can really go wrong in the long run.
But here's the question that might keep you up at night. What if all that comfort is just an illusion? What if your entire decade-long journey of patient, disciplined investing could be completely torpedoed by one wrong move in one really, really bad month? And that brings us to what I like to call the SIP safety myth. See, the problem with just chanting "be disciplined" is that it can make us, well, lazy. We start thinking that just because we started an SIP, we've basically locked in a good outcome. But discipline, as important as it is only half the picture. You see stuff like this all the time, right? But let's be totally honest with each other. This is a huge misconception. No investment on planet Earth is foolproof, and today we're going to look at some cold, hard data to see exactly why that is.
So, let's get down to it. What really moves the needle on your final returns? Is it the day you start your SIP? Whether you got super lucky and started at a market bottom or super unlucky and started at a peak? Or is it the day you decide to finally cash out? Let's see what the numbers say.
Okay, so take a look at this. We've got 4 different SIPs here. Now focus on that start condition column. One of them started in January 2008, literally at a market peak. Couldn't have timed it worse. Another one started at the absolute bottom in March 2009. Perfect timing. Now look all the way over to the right at the return column. It's crazy, right? Even with those totally different starting points, the returns are basically identical, all hanging around 10.5%.
And this just nails the point home. Over a long enough time, if you manage to get out at a good time, in this case, a market peak, when you started becomes almost meaningless. The market just irons it all out. But, and this is a huge but, that's only if you have a good exit.
All right, now for the wild part. Let's run this exact same experiment with those exact same 4 SIPs. We're not going to touch the start dates. The only thing we're going to change is when we take the money out.
And we're not talking about a big change here. We're just shifting that exit date by 2 months, from January 2020 to March 2020. That's it. 60 days. After more than a decade of investing, how bad could 60 little days be?
The answer? Absolutely devastating. Our new exit date is March 23rd, 2020. Yep, the exact bottom of the COVID crash. Now look at that return column. Those beautiful 10.5% returns, they've just collapsed to 1, 2, maybe 3%. In just 2 months, an entire decade of work was pretty much vaporized.
So let's just put this side by side so you can really see it. Exit in January and your discipline pays off big time with over 10% returns. Exit just 2 months later and that same discipline gets you what? 2.5%? This right here is the hidden danger. The difference between winning and losing wasn't the start. It was all about the finish line.
Which leads us to the single most important lesson we're going to talk about. When it comes to a long-term SIP, your exit strategy is, well, it's everything. The timing of when you pull your money out has way more impact and way more risk than when you put it in. And this chart just shows how insane that volatility can be right when you're ready to cash out. Look at this. In January 2020, a 10-year SIP got you almost 11%. 2 months later, that same SIP is barely breaking even at 0.5%. But if you could just hang on for another 9 months until December, your return jumps back up to almost 12%. Your entire 10-year outcome literally depended on which month you decided to sell.
There's actually a technical name for this terrifying roller coaster. It's called sequence of returns risk, and all it really means is the danger that a big market crash right when you need the money can have an outsized, catastrophic effect on your final result.
Okay, so we've laid out the problem, and yeah, it's pretty scary. But the good news is you are not helpless here. You can protect yourself. So how do you make sure one bad month doesn't wreck your entire decade? Let's talk strategy.
It really boils down to this simple 3-step plan. First, plan ahead. And I mean way ahead. Start thinking about your withdrawal a full 2 to 3 years before you actually need that cash. Second, de-risk. As you get closer to your goal, you want to start slowly moving money from your high-flying stocks into safer, less volatile stuff. And third, withdraw systematically. Hey, you put the money in systematically, so take it out the same way. Spread it out over time so you don't get unlucky on one terrible day.
And that's the real key, isn't it? Time is your best friend. It's your ultimate defense. Giving yourself that 2 or 3 year runway to get your money out means you're not forced to sell in the middle of a panic. You have the flexibility to ride out the storm instead of getting swamped by it.
So at the end of the day, it all comes down to this one idea. Yes, be disciplined with your investing. That's your foundation. But that alone is not going to cut it. You have to be just as disciplined, just as strategic about managing your exit.
And I'll just leave you with this one last thing to chew on. All this data we looked at, it assumes that markets will bounce back, just like they always have. But what if they don't? What if the next decade is different? In that kind of world, having a smart, flexible exit strategy isn't just a good idea. It might be the only thing standing between you and losing your hard-earned money. Plan your exit as carefully as you plan your entry. Thanks for watching.